Hello, I'm Brian Roach, researcher at the Global Development and Environment Institute at Tufts University. I'm here today with Dr. James Galbraith, who is an awardee of our 2014 Leontief Prize for Advancing the Frontiers in Economic Thought. Welcome, Dr. Galbraith.
Thank you. It's nice to be here.
Today's topic is health inequality and public policy. And your most recent book, titled Inequality and Instability, talks about the causes of growing inequality in the United States and in other countries. Unlike traditional explanations for inequality, which focus on the problems of globalization or technological change, you argue that inequality is primarily a result of the increasing power of the financial sector.
There is a lot of evidence, and not just for the United States, but all around the world, that the rise of inequality has been driven by concentration of incomes in credit institutions, in the banking sector. That's very clear, yes.
Right. But you also argue that this isn't a result of natural market forces, which tends to be the more traditional explanations of growing inequality, but a direct result of policies.
There is a strong element of policy. We moved from after the early 1980s into a world of very high interest rates and repetitive debt dependency. And that had a crippling effect on poorer populations in poorer countries for practically 2 decades, while at the same time strengthening the positions of those who were basically in a creditor relationship to the rest of the world. So yes, that's the essential dynamic that I've observed in the data.
Okay. And you feel this is true not just in the United States, but in all countries?
Well, all countries is a strong term.
That have had growing inequality.
What we've done, no, it's not true in all countries. What we did was to attempt to compile a fairly systematic and consistent body of evidence. And that evidence broadly supports the statement you just made. It's not true everywhere.
Okay. Do you feel there are particular policies that led to the increase in inequality?
Sure. Of course. I think the movement to let's say, a world economy that is largely a single integrated financial unit has created a lot of co-movement in inequality and a lot of the same general effects around the world. Their timing and their intensity depends upon the strength of the institutions that they confront in each particular case. So you do have countries where matters have remained relatively stable, and you have others where that was not the case. Also, to be clear and be fair, I'm talking mainly about the period from 1980 to 2000. After 2000, with a very much different financial environment, the picture changes, and we see declining inequality in important parts of the world, including in Latin America. And most recently, in our data, we see it very clearly in China as well, which is so that these stories are not once and for all. And one virtue of the approach that I've been working on with my students for some time is that it enables us to use very mundane sources of data that are readily available to make quick calculations that are quite timely. And that's an advantage for countries where you don't have data coming out and available to you every month or every quarter.
Okay. Do you find that there is a common approach among countries where inequality has been reduced, such as China and other countries?
In Latin America, I think you can see the effects of deepening democratic structures and stronger social welfare institutions than ever existed in Brazil before, or in Argentina to a certain degree, Ecuador. In China, it's a little harder to say. I think the two forces that have led toward a peaking of inequality in China are, first of all, increasing regional diversification of that economy. The high growth was initially very concentrated in the south and in Guangdong province and in Beijing and Shanghai municipalities. And as it spreads out over more areas, then you get a decrease in the regional inequality. And then after the crisis in 2008, you get a decrease in the incomes in finance and in other particular sectors, which had also been driving inequality.
Okay. Another point in your book is that economic growth in recent decades has been driven primarily by bubbles, right? The technology bubble of the 1990s, the housing bubble of the 2000s, and with each bubble we've had growing inequality. How do we get beyond a bubble economy? Is there a way to create a stable, widely shared model of prosperity in the future without bubbles?
Well, the experience of the 30s and through the early 1970s was one of building institutions of social insurance and stabilizing counterweights to private finance. And so you had what in the 50s and 60s was called the mixed economy. And we still have it. I mean, these are very important institutions that still exist. But it's clear that since the early 1980s, the balance has shifted very strongly toward the power of private finance, and that's increased the instability of the system. Okay. So reestablishing or re-strengthening some of the institutions we already have would have a broadly stabilizing and also equalizing effect.
Okay, so let's talk a little bit more about policies we could implement to counterweight against the growing inequality. Do you feel we just need to primarily focus on the regulation of the financial sector? Do you feel other policies such as raising the minimum wage?
Well, I think the financial sector needs to be restructured. It needs to be cut down to size. It needs to be focused on, let's say, public purpose. We have a financial sector now which has come to be dominated in recent years by half a dozen major banks. And what exactly they do that couldn't be done by the post office at this stage is extremely unclear. Okay. So they are basically a deadweight fixed charge on the rest of business activity. And that is a problem for everybody who has a bank loan that they have to pay substantial interest on and a bank deposit on which they're getting nothing. So you can see that very clearly. It doesn't need explanation. But I don't think that's a sufficient step. I think that the crucial thing is to expand the network of social insurance so as to protect vulnerable populations from the downturns that happen, particularly when the underlying base of economic growth is quite weak.
Right. And you feel that's the reason, say, certain Scandinavian countries have been able to keep inequality low?
Well, first of all, I'm not sure that they all have, but at least for a long time, strong unions and other institutions stabilized wage structures in, let's say, Denmark. That's clear in the data. But I do think that it's a mistake to underrate the importance of the stabilizing institutions that we have in this country: Social Security, Medicare, Medicaid, unemployment insurance, deposit insurance. The fact is, and the CBO has a new study on this, that for the bottom 60% of the population, a very large share of income lost in private economic activity in the great financial crisis was replaced by insurance programs. And that means that the United States was able to go forward substantially without the kind of convulsive political and social crisis that has occurred in parts of Europe. If you look at Greece, for example, and I've spent quite a bit of time there, you see a small country which is on the verge of a social and political collapse. Healthcare, education, transportation systems. The basic fabric of economic life is unraveling, which by and large, I mean, we went through a big shock here, but by and large, you don't have that sense at all in the United States. So I think we have to be aware that we do, in fact, have important and successful social insurance institutions.
Right. Speaking of that, one of the topics we're talking about today, in addition to inequality, is health. So I was wondering if you could talk a little bit about your views of the Affordable Care Act, and do you think it's an effective insurance policy?
Well, I think the Affordable Care Act was enacted under severe political constraints about what could be done. Some of them self-imposed, as to say, limits on the ambition of its authors. At the same time, is it a step forward compared to what we had before? I think the evidence strongly suggests that it is. We had, I think, some 7 million enrollees at this point, a reduction in the number of uninsured on the order of 5 million. And the question now is, can we effectively control the cost of services to those people so that the insurance policies don't become unaffordable to the mass of people who are now being encouraged by the act to enroll? That's a question to which we don't yet have an answer, but let's see.
Right. Right. I know one of your earlier books, The Predator State, talks about the role of large corporations essentially expropriating some of the functions of government. Do you see that as a threat with the Affordable Care Act?
Well, I think the Affordable Care Act was enacted with, with the interests of private insurance very much in mind, and that was a structural problem that reflected in the argument I made in The Predator State. But the point I was making in that book was that a large part of our economy now turns around these public institutions. And so we have private actors who exist mainly to, let's say, feed off of public institutions. They're not independent market-based entities, but rather, let's say, derivative from the institutions that were created over the 20th century. We shouldn't be surprised by that, but it means that an idea of the economy in which you have a private sector on one side and the public sector on the other, and there's some kind of sacred barrier between the two is misguided and definitely obsolete.
Right. But do you feel the public sector needs to recapture some of the economy that's been captured by the private sector?
I think cleaning up this kind of parasitical activity, whether you're talking about the defense budget or talking about the way healthcare policies are run, is a very sensible thing to do. We should be relying more on nonprofit institutions and on public sector institutions, and be very careful about the conduct of, let's say, ostensibly private profit-making institutions in environments where their position is essentially guaranteed by the existence of a public program. That's the kind of thing that is going to cause trouble, and it is obviously does cause trouble in a whole range of activities.
Right. Do you see public support? I mean, how do we market to the public that there needs to be a greater role for government, that government can be effective?
The public doesn't need to be persuaded of this. The public is on Medicare. The public pays into Social Security, and their parents are supported by Social Security.
Right.
The public knows what the public sector does. I think you just have to speak honestly and not be worried too much about, let's say, the attitude of a hostile philanthropist on the subject, a pseudo-philanthropist.
Right. But at the same time, we hear that maybe 50% of the people that have Medicare don't recognize themselves as benefiting from government programs.
You know, if you believe that. I've never met anybody on Medicare who didn't know how the check was being, how the bill was being paid.
True. Good point. Right. Okay, Dr. Galbraith.
Thank you very much.
Thank you very much for your time.
All right.